Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Nicholas Ong, investment analyst from Phillip Securities Research. Today we'll be looking at Wilmar International. Wilmar's core net profit jumped 53% year-on-year to $314 million in first Q13. The higher earnings were primarily driven by a recovery in oilseeds and grain from 1Q12 losses and higher consumer products. However, lower plantation earnings from weaker CPO price offset the gains. Overall, we see this set of results as in line with our expectation, given that it contributes 24% of our FY13 earnings estimate. Let's look at each individual segment in greater details. Palm and lauric margin started the year better than expected. Margin jumped quarter-on-quarter from $30 per metric ton to $40 per metric ton, even though it was weaker than the $46 per metric ton in first Q12, when the full benefit of the revised export tax in Indonesia was felt. We think this may be attributed to lower CPO fixed stock cost. We believe due to its balanced spread of refining assets at an aggregate level, Wilmar is not showing any pronounced weakness from threat of greater refining capacity additions in Indonesia, as it balances that with greater margins from its Malaysian-based assets. Oilseeds and grain segment, contributed by both oilseeds crushing and flour milling, continued to see quarter-on-quarter recovery in margin from $9 per metric ton to $10 per metric ton, thanks to the lower soybean availability due to logistical issues in Brazil. This had caused soybean meal and oil prices to temporarily strengthen as a result. We do, however, anticipate some headwinds from lower soybean meal demand in second quarter due to the ongoing bird flu, which may dampen the segment's recovery in the near term, with further downside risk if prolonged. Wilmar's consumer product segment continued to perform well in first Q13, thanks to the drop in soybean oil prices since December last year. Margin for consumer product division has improved slightly from $42 per metric ton in first Q12 to $43 per metric ton in first Q13, with volume growth of 10% year-on-year. This helped to grow profits to $57 million, up by 12% year-on-year. As shown in the figure, we see steady execution since second quarter 2011 and Wilmar's ability to ride out the volatility in raw material prices. Going forward, we believe the lower commodity price will reduce fixed stock costs, which should be favorable to margins. Over at the sugar division, as the sugar milling season in Australia only starts in the middle of the year, it is common to incur losses in the first two quarters. That said, we have started to see growth from the Indonesia sugar refining businesses which were acquired, given the government's floor price policy. It reported a lower loss of $40 million in first Q this year, versus a loss of $48 million a year ago. Due to stronger earnings for its sugar merchandising and processing division, with better operating environment, we expect profitability to improve for 2013. Plantation segment was the key weakness in first Q13, while there was 4% year-on-year growth in FFB. Lower CPO prices lead to 27% year-on-year decline in profits. However, we note that the correlation of Wilmar's plantation profit with CPO prices is not very high. Besides volume growth, profitability is also affected by its trading operations. As seen in third quarter 12, segment profit increased 47% quarter-on-quarter despite a 11% decline in CPO price, supported by just 24% increase in CPO production. Hence, while we are forecasting a year-on-year decline in plantation's profit, upside surprise may happen on trading gains. In conclusion, we continue to like Wilmar for its integrated business model and strong management team. We believe that its earnings are more resilient compared to upstream plantation companies during times of lower CPO prices, given that only 23% of its FY12 pre-tax profits came from plantation itself. Wilma is currently trading slightly above -1 standard deviation at 12 times forward P. Our target price of 370 is derived based on a blended PE and DCF valuations. That's all we have for today. Do stay tuned to next week's video. Thank you.